Hi everyone and welcome back to my channel. This video is about 7 strong Canadian dividend stocks for 2026 with economic uncertainty rising and recession risks still very real. Many investors are asking the same question. Where can I protect my capital while still generating a reliable income? And these stocks have proven cash flows, resilient business models, and dividends designed to hold up during market stress. So these are the stocks that are built to weather uncertainty, not just chase the hype. So if you're looking for stability, income, and long-term confidence in volatile markets, this video is for you. But first, why so many long-term investors focus on dividend stocks, especially when fears of recession are rising? First, because of the regular income, obviously. Dividend-paying stocks distribute a part of their profit directly to shareholders, creating wealth and predictable cash flow. This income can continue even when markets are volatile or moving sideways. The second is capital preservation and stability. During period of economic uncertainty or recession fears, investors often, and also institutions, often rotate towards out of speculative assets towards companies with strong balance sheet, reliable cash flows. Dividend stocks are tend to be less volatile and they are perceived as a safe haven when markets are not behaving properly, making them a relative safe haven for investors and institutions. The third point is long-term capital growth. Strong dividend companies are usually mature, profitable businesses that can continue growing steadily over time, even through economic cycles. Historically, dividends have represented a significant portion of total market returns, especially in Canada, and they become even more valuable when price appreciation is limited. In other words, in uncertain markets, dividends don't just reward patience, they create opportunity while others are focused on fear. Now, an important warning, not all high yields are good yields. When a dividend yield looks unusually high, it's often because the stock price has dropped sharply. Because as you know, the dividend yield is calculated by the dividend, dividing the dividend received for the year by the price of the share. So the price, if the price goes higher, then that dividend yield looks really low. If the price is depressed and goes down, the dividend yield becomes attractive. So it's a trap because if the dividend yield is high, that means the stock is depressed and it's depressed for a reason. You have to investigate. So it means also that when the stock price is depressed, it means that the earnings are under pressure, that the dividend may be at risk. That's why the stock price is depressed. Chasing yield alone can lead to capital losses that far outweigh any income received from a dividend stock. The key message is simple. Yield percentage is not a priority, but the quality of the business you're investing in is the most important thing. Every company in this list, these 7 stocks, meet strict quality criteria. And you will find them in all dividend ETF, like the dividend ETF that have selection criterias, like ratios and all that. You will always find these 7 stocks there for a reason, because they have solid balance sheet, predictable cash flow, sustainable payout ratios, and strong competitive positions. These are businesses that can support dividend through economic cycles. They have a history of paying dividends and even paying and raising dividends, not just during good times. This approach may not produce the highest yield today, so the yield won't be like, wow, will not shock you, but it greatly improves long-term results because they are solid business that you will get growth and quality dividends that you know can stay and be stable in the next future. The first one is Enbridge. Enbridge is one of the largest energy infrastructure companies in North America. Its business model is based primarily on pipelines, regulated assets, long-term contracts. And when you talk Enbridge or this sector in general, there is almost no competition. Like the risk of a new player coming to disrupt this industry is really low due to the heavy investments required before you can even get to this sector. This means, and also because of their business model, the revenue depends more on the volume that they ship, not on the commodity price itself. So Enbridge has decades of dividends payment because of this business model, has a long history of dividend growth. It is a dividend aristocrat, and also it's a highly predictable cash flow. because of the way they charge their clients. They usually charge years ahead and not just like a couple of weeks or months. And its core, as a core, it's really considered a core income holding for any dividend investor, especially for investors seeking stability. Next is Royal Bank of Canada. RBC is Canada's largest bank and one of the most diversified. Its earnings come from personal banking, wealth management, capital markets, and insurance. This diversification provides resilience during economic slowdowns. RBC has paid dividends for more than a century and continues to grow them over time. It's a cornerstone holding in many Canadian portfolios. And as you know, Canadian banks are quite strong and can weather economic cycles. Now let's talk about Toronto Dominion Bank. TD stands out among Canadian banks because of its significant and long-standing presence in the United States. A large portion of its earning comes from the U.S. retail banking, particularly along the East Coast. The U.S. exposure brings important benefits for this Canadian bank, starting with geographic diversification, access to much larger economic market. However, it's also important to acknowledge that TD has faced recent operational and regulatory challenges in the US. These issues created uncertainty and temporarily weighed on investor sentiment regarding TD. But what matters most for the long-term investor is how the company responded. TD addressed these challenges, strengthened internal controls, reinforces compliance and risk management, and maintained strong capital position. Throughout this period, TD preserved its dividend, protected its balance sheet, and avoided excessive risk taking. This recovery highlights an important point. Strong banks are not defined by the absence of problems, but their ability to absorb shocks and adapt. And today, TD continues to benefit from that. Diversified earning across Canada and US, conservative lending practices, and disciplined dividend policy. For a long-term income investor, TD ability to navigate recent challenges and emerge stronger is evidence of its resilience and financial solidity, so making it reliable core holding in a dividend-focused portfolio. Next is Canadian Natural Resources, often referred as one of the most disciplined energy producers in Canada. Unlike many energy companies that rely heavily on constant reinvestment, CNQ focuses on strict cost control, long life, low declining assets, and maximizing free cash flow across commodity cycles. This means this company can remain profitable even when oil prices decline. Over the past several years, CNQ has used strong cash flow to aggressively reduce debt, which is good, strengthen its balance sheet, and increase dividend consistently. And in addition to dividends, CNQ has also returned capital through share buybacks, further enhancing shareholder value. While the energy sector is inherently cyclical, CNQ conservative financial management and long-term asset base allow it to perform better than most peers during downturns. For dividend investors, CNQ represents high-quality energy exposure, not a speculative bet, but a cash flow-driven income generator. So it's a great addition to any income portfolio. Now let's move to Power Corporation of Canada. Power Corporation is a diversified financial holding company with significant exposure to insurance, asset management, wealth, and financial services. They own part of Wealthsimple, the popular brokerage service. Its portfolio includes major financial platforms across Canada and United States and Europe. This structure provided several important advantages. First, its diversified business lines and geographies, which reduces reliance on one single market or an economic cycle. Second, stable and recurring cash flow, particularly from insurance and asset management operation, which support long-term dividend payments. And third, long-term capital appreciation as the underlying businesses grow alongside global savings, retirement, and insurance needs. So Power Corp is not a fast growth stock and it doesn't attract much attention, but that's precisely its strength. It offers predictability, resilience, and consistency, which are key characteristics for dividend-focused investors. Scotiabank, often referred as Canada's most international bank, Scotiabank has historically offered one of the highest dividend yield among Canadian banks, making it particularly attractive for income investors. What differentiates Scotiabank is international footprint, strong presence in Latin America, and diversified global operation. This international exposure can lead to more uneven growth compared to domestic-focused banks. especially during periods of global economic stress. However, Scotiabank compensates this with disciplined capital management, conservative payout ratios, and a long-standing commitment to dividend stability. For investors prioritizing income over aggressive growth, Scotiabank offers an attractive balance between yield and long-term sustainability. It's a strong candidate for portfolios where cash flow reliability matters more than short-term performance. The final stock on this list is Labrador Iron Ore Royalty. Unlike traditional mining companies, LIF operates under a royalty model. This means it collects royalties and dividends from iron ore production without directly managing mining operations. As a result, it benefits from very low capital requirements, high operating margins, and limited operational risk. However, dividends are directly linked to iron ore prices, which means income can fluctuate from year to year. This makes LIF different from other names in this list. It's not designed for stable, predictable income, but rather for higher income potential over a full commodity cycle. For this reason, Labrador Iron Ore royalty is best used as a satellite position in your dividend portfolio to complement a diversified dividend portfolio, not as a foundation or a key holding. So the ideal dividend approach, the right approach is to focus really, especially in 2026, to focus on quality first, diversification across sectors, and realistic expectations. Dividend investing is not about getting rich quickly. It's about patience. So it's about building durable income stream over time. So let's summarize. If you are a dividend investor or you're starting to do this, avoid chasing extreme yields, marketing promises, and heavily indebted companies. Prioritize strong balance sheet, sustainable dividend, resilient business models, and this is how a dividend portfolio will survive, how your dividend portfolio will survive and thrive over decades. It's not with hyped up stocks or stocks that have extreme high yield. Try to avoid those, or at least understand what happened to the stock price for it to have such a very high dividend yield before even putting your money there. And it should never ever be your key holding. Your key holding should be quality stocks only, especially headed to 2026. If you find this video useful, please like the video, subscribe to the channel, and share it with your friends and family. On this channel, we focus on clear, realistic, disciplined investing, especially for Canadian investors. Thank you for watching, and I'll see you in the next video.